It was very rough for us at the very beginning because we had to pivot.
I had a very classic startup operating journey where I came in go to market, and within 3 months the company need completely shifted.
We've got 26 companies in the portfolio, a few names you might have heard of, likes of 𝗙𝗂, Interactive Investor, we exited last year.
Similar to Daniel, had the ups and downs. It's a bit of a roller coaster, as you can imagine.
So, thank you all for joining us this morning, especially those of you that are out at 4 a.m. I know this is the 11th of Rare Founders events. He's one here. This is the finale for the year, so hopefully we're leaving with a bang. For those that don't know me, I'm Kyle from the Shift Open Finance community. We represent 220 fintechs across the UK that we help connect founders to founders, founders to investors, and founders to financial institutions. We also actually have our Ignite program, which is an investment incubator, helping founders right at the start of their journey. Our first investment actually being Jim from Canary, and our second being this lovely lady at front, Andrea from 𝗙𝘂𝗶𝘁𝗶𝗴𝗵. So hopefully I can also give a perspective of the fintech side and the investor side a little bit, though we're a lot earlier stage than you two. Now, we're going to do a little straw poll to see what kind of make up the audiences before we go into our panelists. So, the topic is navigating fundraising challenges for fintech companies. So I'm assuming most of you are founders or operators within fintechs that are looking to fundraise. So could I get a hands up if you haven't raised any money yet or you're bootstrapping? Oh, okay. Okay, a lot on the very early stage. Interesting. What about ones who's raised a little bit of money or in your pre-seed now? Okay. Seed stage? One at the back. Can we go any higher? Series A? And anyone beyond Series A? Anyone on the corporate side? Oh, okay. Okay, awesome. That's very interesting. So that's the makeup of you. I'm going to try and be floating as many questions like that, so make sure you're aware, ready with your questions and ready with your hands up. But without further ado, we have an amazing panel today, and I really want to go into each of your introductions. So can you please give us your background, your story, the company you're now working with or running, and yeah, just a little bit about your fundraising journey.
Hey guys, I'm Daniel. I'm the founder and CEO of Doshi. We are a gamified financial education platform. Think of us as the Duolingo for money. Our business model is actually to partner with financial institutions such as credit unions, building societies, lenders, as well as retail banks to help them engage their users through engaging financial education. So we embed ourselves into their platforms, through their apps. We can also white label our solution completely. And we've been on this journey for 3 years. We started as a B2C company. We had to pivot very hard. We had to fire people and a lot in the beginning and really kind of build from scratch again. We raised 2 rounds, around 1.2 million in total. That being said, it was very rough for us at the very beginning because we had to pivot, and we are now on track again, and we have around 400,000 in ARR at the moment. And yeah, it's been a really rewarding journey, but also a very tough journey for me.
I'm Stella. I work on the investment team at Nauta. We are an early stage B2B software focused fund, and I focus on fintech within that. We invest from seed up to Series A, and we'll typically invest 1 up to 5 million into the companies that we support. But on my background, I previously worked at a fintech company called 𝗙𝘂, and they were at the intersection of fintech and healthcare. It was insurance and financing products for IVF. I had a very classic startup operating journey where I came in go to market, and within 3 months the company need completely shifted. So that's when I went into ops, and that's when I had my sort of baptism by fire and what it means to be in the weeds of the business and keep the cogs turning on the engine. I did a lot of credit underwriting, a lot of insurance underwriting, and a lot of accounting and payments. So pretty much helping to keep the back-end ops in shape.
Hi everyone, I'm Johnnie Martin. I work as an investor at Augmentum Fintech. We are a fintech-focused fund investing at the Series A and B stage in fintech companies across the world. We normally like to write a first check of kind of £5 to 15 million pounds, and then be pretty supportive as the company progresses. Always like to take a board seat, be quite active where we can. We've got a bit of a different structure to most VC funds in that we're actually listed. which gives us quite a cool permanent capital vehicle. It allows us to be a little bit more flexible in how we deploy. We've got 26 companies in the portfolio, a few names you might have heard of, likes of 𝗙𝗂, 𝗙𝗂, Interactive Investor, we exited last year. I joined the team a little under 3 years ago, so just as the peak of venture was coming off, which was a pretty interesting time to join. Lots of work supporting the portfolio and helping them navigate through that time. I have a little bit of a different background, slightly more corporate than Stella. I started my career at PwC, qualified as an accountant there, served my time, and then moved into venture via a stint in private equity.
Hi, I'm Jim, CEO at Credit Canary. Credit Canary is a data platform that allows consumer credit lenders to make better decisions about their customers throughout the loan term. And we're doing that by kind of uniting lots of different data sources to provide really contextual insight to help give consumer credit lenders the competitive edge. Credit Canary's been running for nearly 2 years, well, it'll be 2 years from January. We raised a pre-seed round last year and are just doing a small angel round at the moment. Similar to Daniel, had the ups and downs. It's a bit of a roller coaster, as you can imagine, like running these types of businesses, but, try and kind of find the positive in everything and, really push on. And yeah, looking forward to exploring some stuff. And I'll just be a bit open because, I've just been messed around by an investor. So I'm feeling a bit punchy in what I might say. But this time. Yeah.
That's brilliant here. Really expert panel. Hopefully we don't have a fight break out. And I like the founder cushion between the investors we have sitting up here as well.
It's a sandwich.
Got them in. Okay, so we're going to go through 3 challenges today, mostly about the balancing act that is investing. So the first challenge is about growth versus profitability. The second one around fundraising versus operations. And the final one around funder and founder alignment. So for each of those topics, I'm going to ask you a little question at the start, and there's going to be room at the end of each one for questions. So, kicking off with growth versus profitability. For an early stage fintech, when going for fundraising, what do you think is more impressive or important to show? Put your hands up if you think it's growth. Got a few. Okay, yeah, we're talking user numbers, we're talking revenue, nice. Put your hands up if you think it's profitability. Well, okay, we've got more for growth, but there's a lot of in-between hands I'm liking. So, we're now going to pass over from the founders firsthand. Between you, you've raised millions, Jim and Daniel. Now, you've obviously spoken about some of the figures there and some of the struggles you've had along the way. For you, what's been more important at that fundraising journey? Showing growth or profitability?
Well, I think the best thing is to have a great story to get your first ticket in the door. I think that's probably before you even a pre-seed round, I think you have the opportunity to really paint the vision of the company. And I think that's probably the easiest time when to raise money. I think we raised money within 4 months, 600K or something. And that because we didn't have a story. We had a great story and we didn't really have to show any traction. Once we actually had to show traction, it was becoming really, really difficult to fundraise because we were focusing on kind of vanity metrics. We said, oh, let's get to 20,000 customer users. Turns out that, that's not very impressive if you can't monetize them down the road, which was our problem. So we had, great user traction, but we didn't have any business model that's underlying that growth. And then the fundraising became really, really difficult. And we also realized that some of the investors we took in money from weren't really, they weren't going to follow on our round. So we ended up figuring out, oh shit, so growth is great, but it has to be a very specific type of growth. It's actually growth that needs to be sustainable to help you then get the follow-on funding. And we were just focusing on a very, not the right type of growth, I would say. Now, because we had that moment, we are now focusing way more on at least making sure that our, I would say, initial costs are being covered. So all of our, all the people like myself and my team included, we cover that through our revenue. And if you want to actually go and grow, then that's the additional kind of that's kind of the fuel that's going to build the business, and it's going to grow it much faster. But yeah, I think our mindset has really shifted after we've kind of looked for the wrong metrics.
So I completely agree with Daniel on the story and like having conviction on that as to like how you take it forward. I think from our perspective, like when we started out post-raise, we went on this charge of trying to get in kind of more larger corporates because we felt that that would lead to like more of a desirable story to support follow-on investment. But actually, it's very difficult to define that. And actually, we took a kind of call very early on in that like we were going to have a balance between the two. So our view was like it's going to take us ages to extract any money out of like banks to do pilots and all this because we're unproven, but less so kind of on the lower side of the market. So what we've kind of took the view was look, let's kind of get a good panel of like smaller lenders that can help us wash our face, and then anything on top is like the upside. And our kind of view going forward is, well, let's continue that route. Like we know that, like at the end of the day, like we're in this like for venture returns. We're not in it to create like a lifestyle business, and so we are doing that, but we have to be mindful that we have to do it in a very considered way to make sure that whilst we are demonstrating that we are able washing our face, that we're not doing it at the detriment of opening up future funding opportunities. So I think taking a quite considered view as to what the story is and where you're going to go with it, I think has been our learning. We are still learning, but I think you've got to lead with conviction. But the underlying story, as Daniel said, is critical, and not changing on it, not moving around, and using that as the baseline to update your investors, update your customers as to what you're doing, where you're moving, where you're tracking, what you're seeing in the market, like how you're going to change the world, is ultimately what's going to get you stood out going forward.
Interesting. Okay, so the founder's view is focus on the story rather than the figures of growth or profitability. And it seems fairly obvious now you've said it, but of course, you're raising the fundraising so you can have the growth at the start, and then it's looking towards that profitability. It's always that balancing act.
I think we say story, but I think Daniel will agree with me, is like we're trying to create a desirable business. Yeah. We're trying to create a business which like investors look at and go, oh, look, they've got like 10,000 users, or go, fuck, it's like these guys have got like a really good business here, and we need to back it now. Yeah. And I think that's what I mean by story. I don't mean vanity metrics. Yeah. Sorry for swearing.
No, that's perfect. You're all welcome to swear if you want to as well. The audience is fine with that. Okay, so now we're going to go over to the investor side. Now, Jim mentioned there about venture returns rather than lifestyle business. I know, Stella, you have quite a unique view on this, so I'm going to pass over to you.
Yeah, and just to say, I've met a couple of founders who we spoke to for an investment opportunity, and case in point owned maybe... they had 2 people working on a business, so owned the entirety of it, and were generating 200k in annual revenue. So 400k in annual revenue. So each was sort of pocketing 200k. Great, that works really well for some people, and there's nothing wrong with that. The point on venture and venture returns, venture funds and a fund like Nauta, where I am. You raise a fund, you start deploying it, and you have normally about 5 years to deploy that cash. And then you have about 5 years after that to see returns in all of the portfolio companies that you invest in. That means that when we invest $1 million or $2 million or $5 million, then our share, in our view, needs to return that fund in a 200 million fund. That's the kind of size of outcome that we are investing in, and that's what venture is. There's lots of other ways to fund your business, and God forbid be profitable and use that and reinvest it into the business and grow it really sustainably. But when we're talking about venture, that's why growth matters, because the cycles of funds mean that, and again, on deployment period, we have 5 years to deploy. If you come in year 1, then you have 10 years to return. If you come in year 5, you have 5 years to return the same outcome. So that's just the context there on why growth and hypergrowth often really matters in funds. Depending on the partner that you choose on the investment side, then they will be more or less forgiving or read into the story that you're building in your business in terms of when things go really well and continue to support you, and maybe when things go less well, to do things like bridge rounds or to keep following into other investments. So growth matters, but the points that both of the founders here are making on building a sustainable business is much, much more important, because that will that will help you to survive through all of the sort of macro cycles as well in the long term.
And Johnny, what about you? Growth versus profitability?
I mean, I think, look, especially when we're coming in at the Series A, we're not expecting to be the last money in the door. So therefore, we're not obsessed about profitability. I think what we are obsessed about is having sustainable unit economics. And you've got to have unit economics that make sense. You know, we wouldn't, well, we might, but it'd be very unlikely we'd invest in a company that has negative gross margins, for example. Because that, I just don't, unless there's a very clear reason and pathway to how you'll get there, that's very hard for me to take a view that that will be a sustainable business for the future. I mean, I kind of feel like post kind of Series A and B fundraising, and I'm repeating a conversation we had before, Daniel, but you know, the growth and profitability should be a bit of a choice, that you should kind of be able to run your business pretty close to profitability, but then you're making a choice because you have venture funding to invest more in marketing or open a new market or a little bit of product research that's outside your core. And I think that's the kind of balance to strike, because I think if you can have the ability to switch to profitability, it just gives the company way more optionality. And we've seen it, right? I mean, in the last couple of years, fundraising has been very tricky, to be quite candid. And we've had companies in our portfolio that have been able to kind of just switch the dial from growth at all costs to profitability, and then now are making the choice of, well, actually, let's go with growth again. So I think being able to kind of find that nuanced balance is really key. Sorry, that didn't really answer the question with one or the other.
I think it always ends up being a case-by-case scenario, but it's interesting to hear the investors, the similar perspective, fundamental business with the example of unit economics given there. Now, on this challenge, growth versus profitability, does anyone from the audience have any questions for the founders or investors? We've got a hand straight up. Go on.
How much of that is the founder's choice? Sorry. How much of that is the founder's choice, growth versus profitability, versus a dialogue with their investors and they're pushing you in a certain direction?
I mean, I would say it is 100% a dialogue. I mean, look, when we come in and invest for the first time, we have been presented with a business plan that literally in the articles and the shareholders agreement, it will be agreed upon that the founder is working towards that business plan. So yeah, that has been agreed upon with the investors and the founder. I'd say with the ongoing changes to that, it is a dialogue, and it will depend on how much runway the company has, whether the venture investor wants to be supportive or not. I mean, we had to have a very candid conversation with one of our portfolio companies about a year ago because they were running out of cash. And it would have been an awful time for them to fundraise. And we took the view, well, actually, we don't want you to turn off your growth now, so we're going to put a bit more money in ourselves. Rather than going out externally, we're going to extend your runway and actually kind of see you through this cycle to that next point. So, yeah, look, I think it's absolutely an open dialogue in our fund anyway.
Yeah, and it should be, but pick your investors wisely to make sure that is the case. There's occasional times where you maybe, particularly in hype cycles, lots and lots of funding comes into a business. So a fund has taken a really big bet and a big risk on a company to grow to astronomical outcomes, right? And again, depending on the actual terms that you've signed in your contract, that will give your investor voting rights or not voting rights to be able to support or veto what the company is doing. But it should always be an open dialogue, and that's where best practices is a conversation that you should maybe think about or talk about. But all that to say that when oftentimes in hype cycles, when hyper rounds are raised, that's when those incentives become misaligned and the pressure comes into the founders from the investors more so than maybe it would or should. Yeah.
So all about open dialogue. Any view from the founders where you've had an investor different from that? Has there ever been a struggle when you've kind of lost the decision in control?
I don't know if I'm answering that question, but just to echo the point that was just made from Stella, I think it's probably one of the most important decisions you ever make is who is going to be in your cap table. I think that in the beginning, I think we just wanted money, and it wasn't like a very dumb decision that we made, but like it was just not a very considered decision. And I think we spread ourselves very thinly. We had a very broad, I think we had 12 investors in our pre-seed round, and ultimately 2 of them are absolutely critical. but because we had all of a sudden all these other 10, which actually didn't bring any value, we're just like, okay, shit, now we have to do all the consent needs to come through 12 people, all of the governance and all the stuff. So it becomes a really big drag. And the other thing is like, again, like this is again my case for venture early on. I think what's great about venture is that once you are kind of fucked, there is obviously, you actually have some negotiating power. So we were able to, negotiate with investors to get in more follow-on funding, precisely because we built those relationships very on. They were great investors. They were strategic. They saw the value in the founder as well. They understood the operations of the company, and I mean those people are absolutely invaluable. But you obviously make a trade-off. So, once you take institutional money, you kind of have to, you have that governance piece. But yeah, going back to your initial point, that's probably the most important decision you ever make is who is on your cap table.
Yeah, we've got time for one more question to close up the growth versus profitability.
I've got 2 questions for you. One is, you said pick your investors wisely.
Yeah.
So what's the criteria that you'd recommend?
Oh, okay, hold fire on that because that's the final problem around funder and founder alignment. So we're going to speak to that later. Second question though.
Second one is like you spoke about the thing like at what point to the investor should jump in, right? You said is it like the earlier the better, or what point do you recommend?
In terms of when to fundraise or when to support if something is going south?
Fundraise.
Fundraise?
Yeah.
That sort of always depends, right? It's if you're, I'd say to the point that we've all been talking about earlier, it's all about story and narrative, and you're taking venture funding to continue investing into a process or a product or something that you've built, and make it that much bigger. So I think a really good time to seek investment, whether you're at pre-seed, seed, Series A, is when you've worked very, very hard on something, there's something tangible there, there's evidence for it either already having grown to a certain point or having the potential to, that you just need that money to fuel that growth, as opposed to saying, okay, we've done all of this, we just want to continue exactly what we've been doing, because perhaps in that case, maybe that's where the argument for profitability really comes in, really hone in on what you've got, build a profitable business, keep reinvesting into it from that money, as opposed to venture, which allows you to take a slightly bigger risk to grow on an idea or a product through different streams and hires and marketing campaigns or whatever it is. So.
Perfect. Okay, now we're going to move on to challenge 2. So that was growth versus profitability. Now we're talking about fundraising versus operations. Now, fundraising is an intensive process that almost can become a full-time job for a founder. And I wanted to ask this audience, so what time do you reckon a founder spends more time on? Either fundraising or sales, an operational function that is needed to grow the business? Put your hand up if you think founders spend more time on fundraising. Okay, about half the room. And then put your hand up if you think more founders spend their time on sales. Okay, we've got less. That's really interesting. Okay, because this is going to be quite cool to hear from the panel, because this comes back to the growth versus profitability idea as well. You need to make the sales to have the revenue coming in. So, founders, Jim and Daniel, you are both the respective representatives for your fundraising rounds. You are both also the heads and the spearheads for your sales. How do you balance what is essentially 2 full-time roles and then alongside the other full-time roles you have as the founder CEO? Yeah.
I think with regards to like fundraising and that side of it, I think like one of the learnings that like I've become like acutely aware of is that it's very easy to like jump between like one and the other. But I think if you're committed to driving growth and you want venture style businesses, there is a consistent commitment to be like really focused on maintaining a constant dialogue with investors going forward. How we've done it from a sales perspective is we split the sales function. So between me and my co-founder is more of a technical his technical co-founder. So I basically go out and kind of like sell the vision and kind of what we're doing and drive interest and get leads and get people kind of like buoyed up about what Credit Canary is about and where we're going moving forward. And then once we've got to the point where we can put that company into a buying cycle, they're quickly moved on to my co-founder that then runs them through a more of the detailed sales process whereby we can get a commercial outcome from it. And that gives me then the flexibility to manage then kind of relationships with funders going forward. That said, though, I can't say that I'm like 100% like committed to like fundraising for two reasons. Well, like one, if that was the case, I should have just gone into investment banking. I'd probably earn a lot more. And two, it's like I bloody love like doing product. I've spent my whole career doing product and like product design and building things and getting stuff done and marketing and dealing with growth hacks and just generally sorting stuff out. Like my background's always been as like a COO. So I love like working internally in the company, but you have to kind of get awkward and push yourself out there, and that's something that some founders just are like aren't up to. But it all depends on what you want to achieve. But I think good delineation between what that sales process looks like and then a commitment to constant kind of engagement of the fundraising market, I think is like my two key takeaways there.
I really like that because I think the view of people wanting to get involved with operations product will resonate. Like for me, that's why founders go into business. They want to run the business. They don't want to spend the whole time fundraising. And it's an interesting point you made at the end, actually, because about a year ago, I listened to a podcast that Jim was on, and I still take this advice to this day, which on the podcast... on the podcast, you said you need to be going out to events and speaking to people, and if it doesn't feel at least a little uncomfortable, you're not doing it right or not enough. And that's literally a perspective I take to this day to keep kind of pushing on. But moving on, Daniel, your perspective here?
Okay, so I'm not the natural person who loves fundraising. So for me, fundraising is kind of a mindset game, right? So you have to be in a mindset. And so I think it's a mindset game, it's a momentum game. So you have to be in a mindset, so you have to be you have to like really seek it out and you have to want to do it. And I think you have to be in a mindset where you are confident in going into it, because the truth is, it sucks to get like 30 rejections, right? You don't want to constantly say get a no, right? But that's the matter of the game. The game is to get rejections, and because you just have to kind of deal with that, right? So you have to be in the right mindset. And I think the other thing is you have to have momentum. So going back to what Jim said, I think if you don't have momentum and you're fundraising, you're fucked, right? So you have to keep your ball on to making sure you are on top of your sales, and that's part of it, because if you go into fundraising and all of a sudden momentum drops, then you're going to have very different conversations with potential prospects. So in some way, confidence, momentum, mindset are absolutely critical for me. And I think there are some synergies around sales and fundraising. So I mean, for us, for fintechs, I think particularly if you're in B2B, it's great, because a lot of times, in some way, I'm potentially selling today. I don't know. I'm building a relationship today. But it's all about like being there, being present, having a confident mindset around fundraising. And I think then things do work out. I do think, though, fundraising has to be timed very well. And I think you do have to set yourself very, very clear goals and then fully commit to them. Because if you just kind of let it, like, if you just say, might be fundraising, might not be fundraising, and maybe I'll fundraise, like, I think that's not, I think you have to be super clear on what the strategy is and what your outcomes are. Because otherwise it's not going to be effective.
Brilliant. And there's similar themes you've just pointed out there, which is actually you two founders are focusing on that the cold phase and getting people in, and that could be both perspectives which you're balancing across and utilising the rest of your team to then progress it forward. Any other views on that? And also, mostly focusing on investors, but we can split out to the panel. How can founders and investors make the investment process more efficient and quicker so less time is spent on fundraising?
I mean, that's kind of the $1 million question, isn't it? Billion, yeah. Yeah, million, small. Look, it's really hard, to be quite frank. I think there's a few ways that you can do it. I think the momentum point is really, really important. I think the most efficient fundraisers I've seen when a founder is fundraising for inflection, not for runway. And I think that's true of all stages, whether it's pre-seed, seed, Series A, and onwards. I think if you can come with a really articulate story as to why you need this funding now, if the investor doesn't get in now, they're not going to get in, the ship will have sailed, and it's on an absolute rocket ship, I think that will make investors move very, very quickly. I think if you're coming saying, we're almost out of cash, we kind of need this to bumble on a bit more, that's when it's going to be a lot trickier. Obviously, you need the momentum to do that. So I would say that the kind of operational sales side, as Jim says, that does come first. You know, ultimately, as an investor, we're investing in a founder to run a business, not to fundraise. Yes, the fundraising is an important aspect to keep the lights on, but we do need a founder who can really execute on their business over and above the fundraising dilemma. I think there are little tricks you can do to try and kind of keep investors updated. I think pretty easy ones that we see of sending out a quarterly newsletter, things like that. Show the KPIs you're hitting, show the targets and milestones for the next quarter, show you hit all the ones from the previous quarter. I think little things like that can be quite a low time sink, but actually can just keep you front of mind with a quite close curated set of investors who you would love to lead your next round. I think I would definitely be cautious about speaking to as many investors as possible all the time, just because of time, right? It's probably the most valuable commodity that you have as a founder. But I would curate a list of 5, maybe, investors that you would love to lead your next round and speak to them on a quarterly basis, half-yearly basis, keep them updated. And really the most efficient way to get funding is to be preempted, right? And the hope is that one of those 5 investors will turn around and say, look, you've hit all the milestones we talked about. You're now at that inflection point. You're at the right time for me to invest. Let's run a really quick accelerated process and get this done in a few weeks.
Really good points. I think the other thing to say here is a lot of the times in startups, what ends up happening is you have one person to a part. But imagine if, fundraising aside, if you're the only person running sales and then you're suddenly not able to do it, your business still has to somehow stay afloat. So I'd say sort of distribute your functions as much as you can, or at least even if there's someone who's not the most natural salesperson, that at least they could cover if need be, because you're human and you might need that anyway. In terms of the fundraising process itself, I think it's always worthwhile to maybe get to know some investors earlier on, understand what they're looking for, do your diligence on them as much as they do it on you, understand what they're looking for, when they would be able to invest in your business, and then just be prepared. So listen to what they say when they say, okay, here is our process, this is what we would require, and then when you go to them next time when you're actually actively fundraising, say, cool, you said you needed these things, here they are. Again, a lot of startup mindset is to be scrappy and to sort of take a challenge and sort of deal with it very quickly in the moment. But I think fundraising, if you can afford to, you could sort of build that knowledge base of what investors are looking for and what they need, and maybe sort of lay that groundwork and be able to collect the information that they need very, very quickly. And then as soon as they either ask for it or as soon as you're ready to raise, then you're able to sort of give them that information quickly, and then it will save you a bunch of time as well, rather than them saying, hey, we need your monthly revenue data, and then you haven't got that ready. And so you need to say to either do it yourself, or you need to say to your team, hey guys, can we get our monthly revenue data? And they go, oh, do we have 15 customers? Do we have 20? We don't really know. Like it's all part of keeping track of how the business is going generally.
Brilliant. Always keeping the data room up to date so you're ready. Yeah,
but making that as easy as possible for you at any given point in time. And you'll need that anyway for your accountants or for whoever else. Again, sustainable businesses, I think is what we were talking about before. It comes into that as well.
Perfect. Okay, and on the topic of fundraising versus operations, any questions from the audience on this topic? Oh, one over there.
Thanks, Vasily. More of a comment rather than a question, but would be great to hear from the panelists around the different types of fundraising, typically equity investment rounds, ASAs, CLNs, and whether there's a strategy around which one you might prefer. If for example, I was speaking to an investor a couple of months ago, he identified a business that he really liked. The business wasn't really looking for investment, but he really wanted to get in, and he considered a 𝗙𝗂𝗏 in that circumstance. But yeah, it would be great to hear your thoughts around that in particular.
I mean, I think there's often a big timing piece, right? That equity versus a 𝗙𝗂𝗏 or an ASA or a SAFE, it takes a lot longer. You've got to get lawyers involved. You've got to go through pretty lengthy legal DD process. So, like, it is a longer process. I think we've done that in the past, exactly as you described, that we're trying to be quite preemptive, trying to elbow our way in, and actually a 𝗙𝗂𝗏 can be a really neat, efficient way of getting money in the door. I would say that it can just kind of defer a bit of a problem. Yeah, I've had founders say to me, "Oh, we just want to raise a 𝗙𝗂𝗏 because we don't want to get lawyers involved right now and pay for them." It's like, well, that is just going to make the lawyers further down the line more expensive, right? And that might be fine, but because you might just say, actually, no, we need to be heads down for this year, and let's deal with it down the line. So I think it's a choice. I mean, in terms of, for us as an investor, I think in an ideal world, we would be putting an equity check in. I mean, look, I think it gives us the right to negotiate the terms accurately with the founder. We know exactly what we are buying with our equity, whereas with a 𝗙𝗂𝗏, there is the risk that you're getting dragged into another round that you don't quite know what the terms are going to be. So I think there's definitely merits to both.
I think one thing, I mean, especially this is pre-seed now, but one thing I would definitely recommend is not to do an equity round for pre-seed. I think it's dumb. It takes a long time. It costs a lot of lawyer fees. I mean, there's a lot of other tools out there, and I think we did an equity round. It was so stupid because you have to define these terms up front, and then all of a sudden, regardless of what your future funding rounds are, you will always have to, future investors will want to have better terms, right? So I think the ideal thing is just do a SAFE, do it really easy. Don't do any liquidation preferences up in the front, and then obviously once you have your first really big institutional investor, you anyways have to do an equity round. So, but I would try to avoid one as much as I can. Yeah, that was just what I have to say about it.
Okay, perfect. And we're actually going to move on to the final topic because this has been mentioned already 3 times. I've had to hold this gentleman back from asking his question. So don't worry, we're there now. So challenge 3 is around the founder and funder alignment. Welcoming someone onto your cap table it's a commitment. They say some investor and founder relationships last longer than marriages, and it's also a lot easier to get a divorce. So it's a big commitment and a big relationship. Now, there wasn't an easy question I could ask you here, because obviously everyone wants alignment. No one's going to say they don't want it. So the question I have for you as an audience is around the number of investors you have. So assuming you give away the same amount of equity, same amount of money, would you prefer that equity to be held by 1 to 2 investors or many, 10 plus? So put your hands up if you'd prefer fewer investors holding that equity, 1 to 2. Okay. And hands up for the 10 plus and the more. Interesting. Okay. These have been good questions. It's actually split the room. pat on the back there. So now we're going to go over to the experts on the panel here. I'm going to open up just for the whole panel. I'm going to leave it as an open conversation for you guys to bounce off each other. But let's kick it off with some of the green flags you're looking for in an investor or you're looking for in a company. Thrown in the deep end.
Oh, green flags. I think like a genuine, like honest, like relationship, like and the ability to build a personal relationship, I think is important. I think well, number one is like, are they, what is their intention? Are they able to follow on? Can they deploy? Number 2 is like, can they open doors? Like, can they help us like expedite commercial deals? And then 3rd is kind of like, given that the business is dealing with a bit of a firestorm, can they help me expedite kind of or deal with things like more promptly than I could do in my own right? So I think they would be the ideal, but one of the three would be good. On the flip side, though, like just having like an ally. So some of our investors, so there's one guy who's a chief exec of a large car broking firm, and he was very clear with me up front that like he's, you know, he wouldn't follow on, that was fine. But he's like been kind of like a bit of a mentor to me on like dealing with certain things, and he's opened a lot of doors. So I think it just being clear on like what you set out. What really does like frustrate me on the flip side is when like investors say that they do things and they have this like ethos about what they do and like how they help businesses, and it's all bollocks. And I think that like if you aren't going to be in a position to kind of help people or help the businesses and help the portfolios grow, and it's all just a kind of a facade for you to have a fancy office in Soho, then just be honest about it, because then we can just move on with our lives. So yeah, like I think they would be my kind of green flags. The other thing is like if you're dealing with like public institutions, like bear in mind that like, it might blow your mind, but they might not be looking for shareholder returns. They might be looking for these vanity metrics about driving job growth or economic growth, which, you know, having just seen a new government generally are, again, bollocks. So yeah, like I think just having a really good understanding. But, you know, I've known you for a little while, like a personal. I've known Stella, like, you know, I think it's fine. Like, you know, if we could do a dance, great. If we can't, then at least I know that they're good people, and I'd want to like associate myself with and learn from. Yeah, I've had a little bit of a ramble there, but I hope that's useful.
That was useful, and we might come back to you later on, because at the start of this panel you said you've just turned down an investor, so might come back to that story. But no, sorry, I'll leave it open for the rest.
I mean, I'd really echo Jim's point around, you know, get under the hood of what the investor's actually offering to bring you. And I think the best way to do that is to speak to their existing portfolio. You know, it's something that we always open up, obviously not following the first conversation, but if we get anywhere near a term sheet, that, you know, all of our portfolio companies are very happy to do it. They will have done it when they took investment from us, and I think that is absolutely the best way to learn what an investor is going to bring. I mean, I think, look, for us, as Jim says as well, that the relationship point is kind of the key piece. It's can you work with this person? Often when you're going to bring the most value and be most involved is when things are going badly. Like our portfolio companies that are doing well, it tends to be, okay, you guys crack on, keep going. It's when it's going badly that you're kind of actually in the trenches and trying to help them out. And it's, you know, can you see yourself working with this person? Can you have a really open and honest dialogue and pick up the phone? Yeah, if you call them anytime, are they going to pick up? Because I think that's a relationship you need. I mean, Kyle put it well. It is a marriage. Yeah, average fund life is 10 years. I think the average marriage is 7 years. So it is longer.
I think to add to that, a key thing that the partners at Nauta always talk about is identifying coachability in founders. And that's not to say that we want to tell you what to do. Absolutely not. You're the experts in your business. We invest in you because we trust that you're going to grow it and you're going to build exceptional teams around you. But especially an experienced partner who maybe has seen multiple businesses go through multiple cycles, may have some recommendations on how you approach things, or your thought process, or your hiring approach, or how you go about pricing. And it may sound frustrating at a time if they're really trying to hammer home a particular point about your business, your baby in essence. But they'll often be saying it, and again, pick your investors wisely so that the incentives aren't misaligned, but as long as the incentives are aligned on both sides, those recommendations will normally be coming from quite a good place. And on the coachability point, it's just to say that openness to those points is always really admirable, and a lot of investors will test that during the investment process. But you should also always, as Johnny said, speak to the portfolio and ask for how they've executed the things that they say that they will do. Any partner who will sit on your board, if you expect particular things from them, don't be ashamed to very, very directly say, okay, how did you help a company achieve this? What was your role? What role did you play there? The ones who have done it will have very clear answers, very clear examples, even if they can't name names per se. And the ones who haven't might beat around the bush a little bit. But that might help to find who will be, an active and supportive board member.
And anonymous founders is it's like, if I was asked by a potential client, give me a couple of clients, you obviously give them the best ones. And anonymous founders is like quite an interesting one. Like, you can sign up, it's a Slack community of about 2,000 people, and people will be like brutally honest. So if you say if it's like, oh, I've got a term sheet from Augmentum Fintech, what do they like to work with? People will just give an honest answer. I've never seen one for Augmentum Fintech, but the point is, it's like it's kind of like it's going to take away and it just give you an unbiased view as to actively what they're like to work with. And in my experience from, not all companies are the same as well within a fund. I think you'd agree. Yeah. There are like darlings and not, and so just like it's not apples and apples. Just be mindful of that.
And I think just one point to add here is we're all people and we're all human. And at the early stages especially, like I said, your business is your baby. So your emotions will be heightened. An investor maybe is running a process and they're, really doubling down on your business. And I just think it's a moment for everybody to never really take anything too personally if possible, and just think about the fact that we're all in this industry. We all want to transform the world in various different ways, but we'll all continue to be in this industry for a very long time. So trying to, I guess, keep a sense of civility as you go on and as you go through the process, because you never know when you might need them again or when you might bump into them again in the future. So trying to, I guess, zoom out a little bit and don't let emotions take over in these situations is always really helpful.
Sorry?
Disclaimer from an investor.
We're all human, I promise.
I think most of the things that have been said already, but one thing I personally look for is somebody who actually has, somebody within a team at least, who really has operational experience. I think it is important. Ultimately, we're in a business of running businesses. So I think if it's just, I think maybe a red flag, I wouldn't say complete red flag, is if the first, first meeting is an analyst who just like did 2 years of investment banking and they are judging your company and all they're looking is they're just doing data entry in the first call, and you just feel like you're just like, it just feels like kind of shit, right? Because you're hoping to actually build a relationship, but then they're just like capturing data. So I do think that, previous founders who've raised, who built portfolio companies, I do respect them a lot. But that's not to say that other investors aren't great. But it's definitely a green flag for me if somebody has that experience and brings that into their way how they invest. The other thing is, I think the other point has been made. It's so important who you put on your board. So if that investor is going to be on your board, I think you really have to understand what are their motivations, how to incentives, how do they have dealt with like really difficult decisions on the board, how do they have dealt with, because it's the boards are just mainly for governance, but when things go south, I think they become extremely important. So you really want to pick the right investors who are going to, ultimately, obviously their main job is to return their capital to their shareholders, which is what the board is for. But you really want to make sure that you can really work with that person, because otherwise you're kind of screwed yourself.
Brilliant. I like that I asked for green flags and we had a lot of red flags sprinkled in there as well. You went straight towards it, but it's brilliant points made. And I have more questions, but I'm cautious because I already see hands popping up. So I want to give the audience time to ask. I believe the guy in the beanie was first.
Hi, I'm Ao from Tally Workspace. So it was just regarding green flags and red flags. So this is a question to investors and founders and also to the audience. So when you're going into these meetings, does the office question come up a lot? And do investors see the type of working solution a company may have as like a red flag or a green flag, or does it not make a difference at all? Do they not care? And is it a question that comes up more, or is it going to come up more? Like, for example, with the Amazon CEO coming out and saying from 2025 they're going to be in the office full time. I'm just curious to see if that could either help a company or hurt them when they're trying to raise funds.
I don't think that the particular setup has ever really come into the investment decision that strongly. Perhaps it's helpful to have hubs if you've got remote teams, and to say that geographically there's hubs of people so that people are in similar time zones. But we're in a world where some of our portfolio companies are fully remote, other of our portfolio companies are fully in person. We as a team really like to be fully in person, and we're Monday to Friday in the office, so that's not for everyone. But it's more about executing on the business rather than where you're paying rent for an office space, I'd say.
Yeah, I completely agree with that. I mean, I'd say that that's kind of an operational nuance that we would put down to the CEO and founder, that if they can run their business fully remote, then good on them. That's the decision they've made. If they think they need to get everyone in the office, then again, I'd be supportive of that. So yeah, it's not a red flag or green flag for me.
I think if an investor is going into that minute detail, that's a bit of a red flag, to be honest. Okay, hands up for any others.
Yeah, so in terms of the dating game, I was wondering, so you have the concept that you hear that it's best to get an introduction to a fund or an investor, or you're going to submit your pitch and you have to do a founder's video and you jump through the hoops, or get exposure through an accelerator or an incubator, all that sort of thing. And then there's some VCs that you get the impression that they have a shortcut where if you're ex-McKinsey, BCG, whatever, they're going to love you. Just from your perspectives, what's your feeling around what, if you look at your portfolios or your investors, what seems to have been the thing that works best for you to find your match?
I mean, I think it does really depend. I mean, look, I guess we're investing at Series A, so in all likelihood, the company will have had one, if not two, institutional rounds before us. Look, we have very, very good networks with those seed, pre-seed fintech investors across Europe. They know what we like, we know what they like. Quite a lot of our investments do come from introductions from those people. Just, it's kind of natural, right? That being said, we have got companies that we invested in following a cold inbound. My email is pretty easy to guess. It's Johnnie@Augmentum.vc. I get a lot of inbound, right? And we will try to answer all of them. So I definitely don't think you need a warm introduction, but look, it does help. But then we've also done investments where we've made the cold outbound. So it does happen both ways. But I would say the most common for us would probably be an intro from an existing investor, yeah.
Bringing it back to slightly earlier stage, so we come in at seed, and sometimes there's been an investment before, sometimes there hasn't. Introductions from other investors are always very, very helpful. It does the sort of pre-screening and pre-vetting process for you. I'd love a firm stat on this, but I think on the inbounds, there's probably about 10 to 20 pitches that just come into my inbox per week, and that's on top of the ones that I am maybe looking out for or get sent by other investors. So these are just cold from founders. Again, we do our best to get back. I think in terms of just cold reach outs, just be very thoughtful and again do the prep work on who you're sending them to. If it's too blanket and too widespread, then when we chat to each other, I'll be like, oh, Johnny, did you see this? He'll be like, yeah, I saw it. Like, okay, so did they, and so did they, and so did they. And so it seems like very generalist, as opposed to saying, okay, I know that this is the kind of investor I'm looking for, and trying to sort of really target them and do run a bit more of a thoughtful process, just to, like I said, we see a lot of companies, and that often becomes quite a lot of noise, and we know how to recognize quite quickly what we can and can't do in terms of like the types of companies that we invest in. But equally, try and do your groundwork and homework on what that particular investor is looking for, so that you don't fall into that like bulk category.
Brilliant. Okay, final few minutes, quick fire questions.
Thank you. Hi, everyone. My name is Olga. I'm a founder of AMA, a platform for micro consulting and a marketplace. My question is about the scenario, the question which was asked in the beginning, what's better to have only two investors or more than that? So the question is like, what if it is a scenario with a few investors and they are not fully aligned? And what I mean by that is like they have different view on how to sort of coach a founder or the company, how to achieve this alignment, not just like investor, founder, but multiple investors and one founder, one founding team. Thank you.
Sure. So about making your investment team and all of the different investors getting along, essentially, so relevant for all the panel. And yeah.
Maybe one point to make here is ultimately what matters is who has voting rights. So who is able to go against your decision as a founder, and then everybody else can voice their opinion. But whether or not they have decisioning power in the business is another thing. And then on having a widespread cap table, then you've got either institutional funds or maybe you've got strategic angel investors who maybe have been operators and so on and so on. And so in terms of having a good balance of people, you have different people for different reasons. Maybe you have someone who will be really supportive in future funding rounds. They can really help with that process. But then you've got other former operators who are on your cap table as angels who can say, okay, when you're struggling with marketing or when you don't know how to automate your operations, this is what you can do. This is how you can do it. And actually, through my network, I know someone who is currently looking for a role, and maybe bring them in to shape this function in your business. So there's people who can contribute and say, here are some practical solutions to what you're doing. And then there's other people who, again, on the governance point, who will say, actually, this is something that you need to implement in your business, but it comes down to voting rights on whose voice ultimately and legally really matters in that situation.
And founders, do you have a view on how you keep your investors aligned on decisions to make sure there's not too much pushback?
My personal experience has been probably you don't want investors that are misaligned in putting together on the same round. I just don't think that's going to work long term for you. I mean, if you really cash, obviously everyone has a different situation. If you really need the money, then I get it, but I don't think it's smart. I don't think you should do it. I think you should definitely, with investors, also have a clear leader, like who's going to lead the round. If you have multiple investors with who are kind of put the same ticket in, they then kind of have some issues around. That's going to make it even more complicated. But let's say everybody puts 100K in. 5 investors. Well, you have 500K, which is great, but then you have 5 different voices and no one is going to look up to the other person. So you kind of want to, it's much better to have, let's say, 300K from one investor and then, 50K from the other ones. That's going to make your decision making so much easier. So yeah, I guess going to misalignment, go with one clear leader and have the other ones follow. I think this is probably the best thing I can say. And if you are stuck, then then it comes down to kind of what you're decisioning, how it's governed in your cap table.
Okay, do we have time for one more? Yeah, one final question.
Yeah, hi, my name is Hakim. I'm a founder of an AI-powered market lending place that sits within consumer credit. So from an investor standpoint, and I guess founder standpoint, what is your take in regards to pursuing a product or investing in a product that needs to be regulated, especially being in fintech and we're in the UK, everything's regulated? How have you guys found in terms of investing into regulated services that haven't been regulated? How is your risk appetite? And founders, have you faced producing a product that needs to be regulated, but you can't have growth because you can't operate? So that catch-22.
That's a brilliant question, especially for this panel.
Well, I suppose like from a regulatory perspective, it gives you a strategic moat. Because it gives you kind of a defensibility. I think the thing, like from a regulatory perspective right now, is that one, the FCA has become ever harder to get those regulations through the door. They've changed the process in which you need to apply for those regulations. So previously, it might be like 6 to 12 months. You have like one case officer where you're running through. Now it's a 12-week submit a business plan leading on to like a regulatory like application being successful, and based on the nature of the application that you're looking for, so in your case it might be like a credit broking permission, it might be very different to if you were looking to create like a credit reference agency. I think the thing to be mindful, I can't even speak for investors, but I think things that you need to be mindful of on the regulatory side is the FCA getting much more scrupulous onto the backgrounds of individuals that are part of the business. Like, are you kind of, and do you have the experience to run a regulated entity? You know, do you have the team and advice to support it? Do you have the capital adequacy that would meet the threshold? So you need to have like certain levels of cash in the business depending on the type of regulation in place. You need a lot of like compliance stuff with regards to business continuity. You know, there's much more of an emphasis now on getting ISO and things like that. So it's a kind of a catch-22. My view on it was, or if I can kind of like get into a position where we existed as kind of more processors, where we didn't need the regulation and actually we could kind of remain outside of the regulatory perimeter. Having done 2 businesses where we've been inside the regulatory perimeter, I think that is kind of a good way of thinking about it, but how long that will take you, it depends on how many pivots that you go down. But I think what's really important from a regulatory perspective, like, is to bear in mind that it costs a lot of like cash to be able to make the application and the consulting fees to be able to do that. It's a specialist trait, and you need both like regulatory consultants to make sure that you've got kind of like, and are putting forward solid, defined, like clear business plans to support the application. And then secondly, like good lawyers, and yeah, it's not cheap. So, you know, you need to have it kind of, if I was an angel investor and I was investing in your company and you gave me your business plan, I'd be like going through it. I'd be like, have you really understood what is required to be a regulated entity? Have you put enough cash in to allow for runway? What's your contingency if you don't get regulated in 6 months versus 12, 18? What's the ramp up? What insurance provision have you put in for? You know, there's lots of different moving parts. So I think that's how I would be thinking about it, but it's more of an operational point rather than an investment point.
Yeah, I mean, I think, look, we're fintech investors. We obviously have to be able to invest in regulated businesses. So it's definitely not a red flag. But yeah, I'd echo everything there that, yeah, it's got to make sense in terms of how much funding you're receiving. Have you got the right people in the business? The other thing I would say is I think that your investors can be quite supportive as well. That, I mean, yeah, we have done it. We have written letters to the FCA on behalf of our portfolio companies showing our support, right? And it's also a big deal for us as investors and board members that, you know, if you're a board member of a regulated entity that is in financial difficulty, you know, you are hauled up personally in front of the FCA, right? So I think that it's something that, again, make sure you know who's joining your board, that they're going to be supportive throughout that process. I think, look, if you're getting an experienced fintech investor, they're not going to throw up all over a regulated business, but they're going to need to really be comfortable that you are the founder and you have the team around you to be able to run what is a very sophisticated business.
Yeah, I couldn't agree more. Having worked in a company who was regulated on the finance side and regulated on the health side, and then that was all well and good in the UK, and then suddenly you want to expand into Europe or into the States, and then you have another round of regulators to go. Whatever you think the timeline is, add 6, probably 12 months to that. One of my team had a cactus, which they called the FCA cactus, and they would water it once they would get an email from the FCA, which was normally about every 2 to 3 weeks. The process is very long and it's very draining, and it, I think, maybe took about a year. And even in that process, the delays from their side was because they had a poor experience with a similar type of business and so had concerns, right? This was a personal view rather than a processed view, and so they needed time to get comfortable. If I spoke to any business who was in a regulated space, to echo exactly what the guys have said, would just be to go, how prepared are you for this? And have you maybe done it before? If you haven't, have you spoken to people who have done it before? It's a patience and it's an experience game to be able to overcome those hurdles. And again, taking it back to the very beginning, you're building a venture-backed business. Depending on the timeline that you've got to make the returns that you need to make, if you're saying, okay, actually it might take us 12 to 24 months to get regulated, that is then hurting your growth potential. So maybe early venture money, as you say, maybe early equity funding isn't the answer to that. So that you can lay that groundwork and then get the venture funding once you have the regulation to then be able to grow very quickly. Sorry? The cactus is, of course, still alive.
And I think the other thing on that is that the regulation is just the permission to operate. You still have to have like a great product. So look, just put it into perspective. I think in the UK right now there are like 26 or 27 like regulated credit reference agencies that are that have that license. How many do you know of? 3. Like, you still have to build a great business around it. The regulation is just the permission. And when I kind of hear people saying, oh, well, you know, we're part of the FCA sandbox and it's going to really help our investment, I'm like, yeah, crack on. Like, you still got to like build a great business, and the regulation is just one part of it. It's just your permission to operate and build the business model.
Final thoughts from you, Daniel? No? There's been a lot covered, to be fair. I feel like we could have gone on with that question for ages. I think the only other thing I would add, because you said a very good point about trying to create processes and test without the regulation. The Monzo story, they had the first 1 million customers on a prepaid card before they had their banking license. They tested user experience and everything before they actually opened up as a bank. That's how they got their funding to get there. Now, we have overrun, so apologies for that, but everyone will be hopefully sticking around for a bit afterwards. But always what I love to do to finish up a panel, 1 sentence, max please, just headline tips for fintechs going through the fundraising process at the moment. Start off with yourself, Daniel.
Mindset, resilience, and to be honest, have fun. What else are you going to do in life?
Perfect. Top 3. Stella?
Again, what I was saying earlier, be prepared. Try not to get too emotionally caught up in it, which is much, much easier said than done. And yeah, I think those 2, are the main points that I'd say.
Top 2 from Stella. Johnny?
Yeah, probably quite similar. I think I'd say be prepared for rejection, because there will be a lot of it. But I'd also remain resilient, be as organised as you can, and build those relationships super early.
And Jim?
Always happy to give anybody a hug if it can help them on their way.
Perfect end of the panel. Thank you all so much for coming, and please do stick around.